Today our topic in auditing is planning before the start of a real audit. So the name of the chapter, preliminary audit planning, understanding the auditee's business. So that's our main topic. And I divide this topic or chapter number 5 into two parts. And one by one, we will discuss it. Let's start and see what we're going to discuss in this chapter. First of all, we summarize the financial statement audit process. That there are different types of audits, but if we want to do the audit of a financial statement, what process we have to follow? Like external auditors normally do for every public company or companies registered in stock markets, stock exchanges, the financial audit before issuing to the public or to the stakeholders for the knowledge of the information about the financial position and the financial performance of the company. And the audit is done by the external auditors, and that's what we call it as a financial statement audit. Explain the main characteristics of an independent audit engagement. That's the second point we're going to discuss in this part. Describe the activities that auditors undertake to decide whether to accept a financial statement audit engagement. And the first task performed once an audit engagement is accepted. Explain why auditors need to understand the auditee's organization's business and environment and its risks and control. So before starting an audit, you have to understand and the business, the process, the situation, the market environment, and the overall environment that is useful in assessing the risk of the business. Then use up preliminary analytical procedures on management's draft financial statement to identify areas where misstatements are most likely. That's before the start. So we analyze, we try to understand the business and the environment and see which areas can be misstatement or misreported, or what are the risks associated with that. Explain the materiality levels used for planning the audit and how these amounts are determined. So there is a concept in audit that how much value the transaction or the misreporting is treated to be as a material misconcealment or material misreporting. For example, if there is a missing or not reporting a very nominal amount like a $10-50, then it is not considered to be the material concealment. And that's important that the auditor first define what is material for this business. List the preliminary planning decisions set out in the overall audit strategy. So these are the learning objectives for this whole chapter, 7 learning objectives. We try to cover the first 4 in part 1 and the remaining 3 in the part 2. So the essentials of preliminary audit planning and understanding the auditee's business. So these are the very initial requirements that before accepting the audit of that. Before an audit engagement is accepted, whether it is a new engagement or the continuation of one that was performed in a previous year, the auditor has to determine whether the professional ethics, codes, and requirements of generally accepted audit standards can be met. And these are the ways that you can see whether the generally accepted auditing standards are met or not. Is the auditor independent of the company, both in fact and independence? Independence is a very important. Is there any relationship of the auditor with the auditee that is not accepted? If there is any type of relationship, yes. Does the auditors have the competence and available resources to comply with GAS for this company? Then they have to determine whether they have the capacity, competence, and the availability of resources to audit that firm. Are those charged with the governance willing and able to accept their responsibilities to fairly present the financial statements? So that's also that you are either the company is willing to accept that. Now, if the engagement is accepted, an audit engagement letter is prepared. So that's the first. That's audit engagement letter is prepared. And what are the legal requirements the letter should contain? Number one, nature of the audit. But as I mentioned, there are many different types of audits, and we are discussing here only the financial statement audit. Management's responsibilities and auditors' responsibilities. So this letter, which we call it as a letter of engagement or engagement letter for audit, uh, these three things must be mentioned. Nature, responsibilities of the management. When we are saying management, it's the company's management, the auditee's management, and the responsibilities of the auditors. So the first thing is, before starting the audit, is to risk assessment. Risk of material misstatement in the financial statement is used to describe the possibility that business or environmental risks have resulted in the financial statement not being a fair representation of the company's economic realities. The auditor's risk assessment will identify the key risk areas in the audit. The audit team will emphasize those areas. As I mentioned before, materiality. Materiality refers to monetary amount. It can be $100, it can be $1,000, it can be $5,000. Amount that auditors believe financial statement users would find significant or material to their decision making. Used for planning to perform the audit, used for concluding whether financial statements are materially misstated. Overall audit strategy. Then we have to develop, or the audit firm has to develop the overall strategy. Record all deliberations and decisions in planning in the document called overall audit strategy. Now, the audit process and overview of an independent audit of financial statements. So this audit process starts from risk assessment. Under the risk assessment, we have to pre-engagement activities, preliminary and planning, risk identification, risk assessment procedures to plan audit. So these are the three things we have to cover under the risk assessment. And then responses to assessed risks, internal control documentation and testing, sampling decisions, substantive procedures. And then we have a concluding and reporting, review audit findings, and then form an opinion and issues report. Now, audit process, ongoing activities, communication among audit team members throughout the process. So we have to properly document and also have a record for all the communications among the audit team and the management. Documentation of the audit decisions and findings, that's also important. Revisions to risk assessment and the planned responses is, if appropriate, due to the knowledge obtained during audit process. Communication with those changed with the auditees, governance and its management, charged with the auditors. Independent audit engagement characteristics. What are the characteristics that makes an audit independent? So that's important to know. A wide variety of organizations or entities are required to produce financial statements to meet their external stakeholders, information needs, and to have them independently audited. So and this is again, it's a audit is a three-party agreement. One party is audited and one party is doing auditor, and the third party is the reader of that information. So it means that the auditors are authenticating. So when you are authenticating some information, so it's very important that how you become an independent. At the outset of an audit engagement, it is important for the auditors to understand what kind of entity is being audited. So what kind of entity means, is it a profit organization, it's a non-profit organization, or it's a public company, or it's a partnership, or it's a sole proprietorship. So you understand the entity very clearly. Who the people are who are charged with the governance of the entity, who is the responsible for the governance of this entity, the stakeholders to whom they are accountable, that who are the interested parties to read these financial statements, and the client's reason for wanting an auditing, and why the firm is requesting for the audit of the financial statements. Acceptance decision pre-engagement activities. So auditors undertake two types of activities before being an audit. Number one is risk assessment and number two is quality management. Auditors try to reduce the risk probability of something going wrong by carefully managing the engagement. And quality management means that the auditors manage audit in accordance with the quality control standards. Client selection and retention. An important element of an audit accounting firm's quality control policies and procedure is a system for deciding to accept a new client and whether to resign from an audit engagement. Accounting firms are not obligated to accept undesirable clients nor retain existing audit clients. So that's not responsible to retain. It's not necessary that once you did an audit, it's that you have to do it again. Audit engagement acceptance and continuance evaluate auditors' independence and ability to comply with other relevant ethical requirements. Obtain information from the prospective auditee's management in order to understand the business and its risks, to assess whether the organization's manager able to accept responsibilities for preparing financial statements in accordance with an acceptable financial reporting frameworks, and for implementing adequate control to reduce risk of error and fraud. So as you know that it is the management responsibility to prepare the financial statements. Auditor's job is not to prepare the financial statements. Auditor's job is just to evaluate or authenticate or find out is there any misreporting or misstatement in the financial statement. So for that reason, the first thing is that they assess first whether the management has the capabilities to uh, form the or to prepare these financial statements. Consider whether the firm has the competence and resources to perform the audit. Consider whether the engagement requires special attention or involves unusual risk. For new audits, communicate with the previous auditors. So if you are taking a new firm and this firm has already audited last year by someone else, so you have to communicate with the ex auditors as well. So they can give you some ideas about the corporation. The auditors considers whether the financial statement presented in accordance with the generally accepted accounting principles, whether management understand its responsibility for preparing the financial statements and for designing and implementing adequate internal controls, management's commitment to provide written representation or other scope limitations. Auditees retention. This decision to continue auditing an organization are similar to acceptance decision. So it's not so much different that you are doing the audit of the same firm again this year, or you have to start a new client. The public accounting firms will have a more first-hand experience with the auditee. Annual retention reviews take into account changes for the auditee. Communication between predecessors and successor auditors. As we mentioned earlier, that there must be a correspondence or communication between the old, if we are retaining or if we are starting a new client, then you have to talk to your ex auditors. So when the companies change auditor, the former auditor is the predecessor auditor and the new auditor is the successor auditors. So predecessor and successor. So successor must contact with the predecessor and talk about the firm. Rules of a professional conduct requires the successor auditors to contact the predecessor auditors, ask if there are issues that should be considered in accepting the client, and obtain information from the predecessor auditors for planning the audit. Predecessor audit is required by the rules of conduct to respond to the communication, and by their ethical standards or the standard for accounting, the predecessor should have to communicate with the successor. Communication between predecessor and successor auditors. Successor auditors should ask the client to consent to discussion with the predecessor auditor. So they first ask the client that you don't have any objection and you get the consent that they are discussing in this firm with the predecessor auditors. Consent is not required. The communication must take place even if the consent is not there, but we have to take a communication. Consent allows the predecessor auditors to relay more information. Basically, the consent is just to give full information, or you have to restrict yourself up to certain information. But that's predecessor auditor still has a duty to maintain confidentiality. Audit files belongs to auditors, not the client. That's a very interesting point to remember here and understand legally. The audit files belongs to auditors, not to the client or the auditee. So the auditor can share the information with the successor because these are not the problem of anything, because these are the files owned by the predecessor. So author should be wary of client who refuses consent. Key factors to consider: how widely distributed are the audit financial statements. That's also important, that how big the firm is and how many stakeholders are involved in the or interested in to read these financial statements. How strong is the financial condition of the auditee? How trustworthy is the auditee's management? That's also how complex is the financial reporting required, and how knowledgeable are the people using the financial statement likely to be. So you understand the audience or the those who are interested to read those financial statements, so that you have to prepare according to the standards of the reader. Engagement letter. So when a new audit client is accepted, an engagement letter must be obtained. The engagement letter forms the contract for the audit, and standard requires the auditor and the management to agree on the terms of the audit engagement. And a new engagement letter should be obtained every year of a continuing audit firm. So this engagement letter is required not only for the new audit firms, but also for the continuing audit firms, that they should get it before starting the job. Staff assignment. When the new client is obtained, accounting firm assign a full service team to the new client. The audit team may consist of just one or two people. For larger auditees and public companies audit, a second review partner might be required. Then we have to time budget or planning regarding the timelines, what we're going to meet. The partners or the managers proposes a plan for the timing of the work based on previous experience and the knowledge of the business. The time budget allows the audit firm to spread its workload between interim and the year-end periods. So interim, week or months before the statement date, and year-end shortly before or after the statement date. Like if the firm is ending their financial period or financial year on December 31st. So there are two types of things that interimly, weeks or months before the statement date, like the 31st December, and 1 week or shortly before or after the 31st December, so that they can start in their work. Everyone on the audit reports the time taken to perform the audit procedure. The time reports are recorded by the time budget categories to all for evaluation of the efficiency of audit team members. The time lines and time budgets are also helpful in analyzing the uh, performance of the audit team as well. So billing the client, that's the second objective of time planning, is that they can bill the client for auditing according to the time they are using. Planning the next audit of the client. So that's the way that scheduling, because if they are continuing for the next year, so if we are finishing this time of the year, then when we will start the next year audit. So this is our first part of the chapter, in which we discuss that how we plan time budgeting and the letter of engagement. So these are the two main areas we discussed in part one. So uh, now we will discuss the remaining portion in the second part.